Let's break down how speed can make you money in crypto. Crypto prices move in seconds, sometimes milliseconds. While most people check prices occasionally, elite traders operate at lightning speed. Imagine a massive flea market where every vendor sells the same mug, but prices change every second. If you could instantly buy low and sell high, even for a tiny difference, you'd profit, especially if you do it thousands of times a day. This is the essence of high-frequency trading, using automation and speed to exploit tiny, fleeting opportunities. It's not about holding and hoping, it's about rapid, repeated trades for small gains. Automation is key. Computers do the heavy lifting, and being even a fraction of a second faster than others is everything. Today, we'll dive into high-frequency trading and crypto arbitrage, how bots find price differences, the strategies they use, and the risks you need to know. Nothing in finance is risk-free. So let's make sure you understand both the rewards and the dangers. Let's get started. High-frequency trading, or HFT, is all about using powerful computers and algorithms to execute thousands of trades in microseconds. Humans can't compete at this speed, only machines can. HFT isn't about long-term analysis, it's about exploiting tiny temporary price gaps. Speed is everything. Firms spend millions to get as close as possible to exchange servers, sometimes even in the same building, to shave off milliseconds. Automation is the second pillar. Bots, not humans, run the show, following strict rules like if Bitcoin is cheaper on exchange A than B, buy on A and sell on B instantly. Thus, bots never sleep, never hesitate, and never get emotional. HFT is a game of volume and tiny profits, maybe just a fraction of a cent per trade. The goal isn't a big win on one trade, but thousands of tiny wins that add up. Imagine finding a penny on the ground. One isn't much, but a machine that finds 1 million pennies a day, that's real money. HFT relies on repeating this process at scale, turning small opportunities into substantial profits. It's relentless, precise, and only possible with cutting-edge tech. That's the power of HFT in crypto. Let's see how it works in practice. Here's a simple example of HFT in action: cross-exchange arbitrage. Crypto prices aren't identical on every exchange. Small differences pop up constantly. Suppose your bot sees Ethereum at $4,000 on exchange Alpha and $4,002 on exchange Beta. Instantly, it buys on Alpha and sells on Beta. No hesitation. The result? A $20 gross profit minus a few dollars in fees. It's not about one lucky trade. The bot does this hundreds or thousands of times a day. Each small win adds up, turning tiny price gaps into real money. The magic is in the speed and automation. No human could react this fast. This is the bread and butter of HFT: rapid, repeated, nearly risk-free trades. It's all about scale and precision. That's how HFT bots turn pennies into profits. Arbitrage is about exploiting price differences between markets, but there's more than one way to do it. The classic is exchange arbitrage: buy on one exchange, sell on another. Speed and low fees are crucial. Triangular arbitrage happens on a single exchange. Trade between 3 currencies in a loop to end up with more than you started. For example, USD to Bitcoin, Bitcoin to Ethereum, Ethereum back to USD. If the rates line up, you profit. Then there's decentralized arbitrage, using DEXs like Uniswap. Prices are set by formulas, not order books, so gaps can be bigger but come with higher risks and fees. Arbitrage isn't always risk-free, especially in crypto, but these strategies are the foundation. Each type has its own challenges and opportunities. The key is finding and acting on these gaps before they disappear. That's why automation and speed are everything. Let's look at why these opportunities exist. Why do price gaps exist in crypto? It comes down to fragmentation, volatility, and liquidity. Crypto trades on hundreds of exchanges, each with its own buyers, sellers, and prices. Prices don't sync instantly, so gaps appear. Volatility means prices move fast. One big trade can create a gap before others catch up. Liquidity varies. Big exchanges handle huge trades easily. Small ones don't, so prices can spike or dip. Arbitrageurs help balance things out by buying low and selling high across markets. But fees and transfer times matter. If it takes too long to move funds, the opportunity vanishes. That's why pros keep funds ready on multiple exchanges for instant action. It's a constant race against time and costs. Combine HFT's speed with arbitrage's price gaps and you get a powerhouse strategy. Humans can't compete. By the time you spot a gap, a bot has already acted. HFT bots connect directly to exchanges, executing trades the instant a profitable gap appears. For complex plays like triangular arbitrage, bots run calculations thousands of times per second, firing off trades in a split second. Crypto markets never close, so bots work 24/7, scanning for opportunities worldwide. They thrive on volatility and low liquidity, capitalizing on moments humans would miss. HFT gives traders superhuman speed and reach. It's the ultimate edge in a market that never sleeps. But why go to all this trouble? Let's find out. Why invest in all this tech and speed? Simple: profit, risk reduction, and opportunity. HFT arbitrage turns tiny price gaps into steady income by trading at massive scale. It's market neutral. Trades are completed in seconds, so you're barely exposed to market swings. Bots can scan millions of data points and act on opportunities no human could spot. Even in quiet markets, HFT systems keep finding trades. Plus, they help make markets more efficient by closing price gaps. Everyone benefits, prices align, and the market becomes fairer. But the competition is fierce and the risks are real. Let's talk about those risks. HFT arbitrage isn't a money printing machine. It's packed with risks. Execution risk and slippage. Prices can move before your trade is filled, turning a win into a loss. Competition is brutal. Giant firms with top tech are fighting for the same gaps. As more bots enter, profits shrink and disappear faster. Fees add up quickly. Your strategy must cover all costs or you'll lose money. Running servers, buying data, and developing software aren't cheap. Technical and security risks are huge. A bug, outage, or hack can wipe you out in seconds. Bots need access to your accounts. If your security isn't airtight, you're vulnerable. This is a high-stakes game, not for the faint of heart. Only the best prepared survive. So how do you get started safely? If you're still interested, start with education, not your life savings. Learn how markets and APIs work and consider picking up some coding skills. Before risking real money, practice in a simulated environment. Most exchanges offer paper trading. Test your bot, refine your strategy, and make sure it works after fees and slippage. If you can't make money with fake funds, you won't with real ones. Security is non-negotiable. Use strong passwords, two-factor authentication, and limit your bot's permissions. Run your bot on a secure, dedicated server. Treat this like a business. Protect your capital at all costs. The world of crypto HFT and arbitrage is fascinating, but it's not for beginners. The competition is fierce, the risks are high, and mistakes are costly. Start with knowledge. Test thoroughly and always prioritize security. There's no free lunch in HFT. You're up against the fastest and smartest. Trade smart and stay safe.